Good morning, all. Receive warm greetings from Nairobi, Kenya. Thank you for taking the time today to join our webinar, where we unpack a recent decision of the Kenya's Tax Appeals Tribunal on the taxation of carbon credits in Kenya. This decision was in the Wildlife Works Sanctuary Ltd case and was decided late last year. And we're excited that you have joined us for this, what we hope to be an informative session. Next slide. So today, the session is scheduled to take an hour. And in that hour, we will share about CDH and then give an overview of carbon projects in Kenya, review the Wildlife Works case, share a bit on global trends on taxation of carbon revenue, and then conclude with key takeaways, and then open up the session for discussion and a question and answer session. So about CDH, we're a top law firm in Africa, focusing on business law. We have offices in South Africa, Cape Town, Stellenbosch, and Johannesburg. We also have an office in Nairobi and one in Windhoek, Namibia. We have more than 260 lawyers and a track record spanning over 170 years. And what differentiates us in the market is that we offer partner-led approach to our assignments. We are highly specialized with practice groups and specialized sectors. We believe in partnerships and partner with fellow lawyers across the continent and within the firm internally. We have cross-border capacity. We believe in empowering our clients. We add value to our clients, and we value reputation, where we seek to ensure that we minimize risks for our clients and enhance benefits in the business world. Our practice areas are quite broad. We are a full service firm. We focus on tax and exchange control, environmental law, banking and finance, and projects, corporate commercial law, dispute resolution, employment law, real estate law, pro bono and human rights, data protection, and technology and communications. Today's webinar is presented by myself. My name is Clarisse Wambua. I'm a consultant and I lead the environmental law practice at the Nairobi office of CDH. And I have over 20 years of experience in legal practice, and I have been working in the carbon market space since 2010. So that's about 15 years now. I have worked with project developers on transactions, on contract negotiations, and also I was involved in the regulatory impact assessment of the carbon market regulations of 2025. I'm joined on this webinar by Alex Kanyi. Alex is the lead partner in charge of tax and exchange control in the Nairobi office, and he has extensive cross-jurisdictional experience. He has worked in Kenya and in Ireland, and he advises clients with operations across the globe. He's a member of the International Fiscal Association, the Law Society of Kenya, and the Institute of Certified Secretaries. And he has been recognized as one of the top lawyers in tax in Kenya by Chambers Global, as well as the ITR World Tax Rankings. He has also received commendation for being Commercial Lawyer of the Year at the annual Nairobi Legal Awards. So Alex and I work in the environmental law and tax exchange control departments, and this webinar is presented by both teams and is a collaboration between the teams. The environmental law practice leads the work on carbon markets. We have been supporting on regulatory compliance. We support on climate change policy and legislative drafting, due diligence support, climate impact assessments, contract work, and advisory on projects, as well as supporting on litigation together with the disputes team. When it comes to carbon markets, the tax exchange control department is heavily involved in assisting clients with tax planning, restructuring, tax health checks, transaction support, transfer pricing, and also supporting with dispute resolution with the Kenya Revenue Authority. So off that background and introduction of ourselves, I'll now go into just sharing a brief overview of the carbon project landscape in Kenya, which is where the Wildlife Works project is involved in, and which is a subject matter of the case we shall be discussing. So in Kenya, carbon projects have been ongoing, and the first one was actually quite early on in 2005 is when Kenya registered its first carbon project. And since then, we've had a number of projects, and these are really programs or projects or products that either remove, reduce, sequester, or avoid carbon emissions. And Kenya has actually been a leading participant in the global carbon markets. Our reports indicate that as of 2023-2024, the country had issued over 52.4 million carbon credits. And the carbon landscape can be dichotomized into land-based projects and non-land-based projects, which is actually how our carbon markets regulations have conceptualized the carbon project landscape. So land-based projects are those that are related to land use, land management, and ecosystem conservation or restoration, and they are aimed at reducing greenhouse gas emissions or enhancing carbon sequestration. And an example of this is a REDD+ project, which the case involved of the Kasigau project is actually a REDD+ project. And REDD+ is a project that reduces emissions from deforestation and forest degradation, and uses results-based payments, or can also be active in the voluntary carbon markets, and then earns finance that helps further conserve forests or keep the trees standing. So in the non-land-based sector, we have projects that reduce greenhouse gas emissions or remove carbon dioxide from the atmosphere using technologies that generally do not require land. And this can be seen from the kinds of projects we have seen in Kenya and across Africa. A lot of solar lights, energy efficient cook stoves, water purification devices, and electric or green transport solution projects. So what we have seen, and this is from a report by the World Bank, is that Kenya has seen a progressive issuance of carbon credits. From the graph on the screen, we have from 2011 to 2022, quite a clear indication of increasing issuance in the country. And also what stands out is that the projects are varied, but there's one clear sector or area that has had the largest number of issuances in the period 2011 to 2022. 56.1% of the projects were from the forestry and land use sector, and that is where the most credits have been issued in Kenya. You do have household and community as well at 32.1%, sustainable agriculture at 0.5%, and renewable energy at 11.2%. And I'll just comment on renewable energy. It's not surprising because Kenya has one of the leading geothermal production capacities. We have the largest wind farm at Lake Turkana wind project, amongst many other renewable energy projects. With regards to the regulatory environment for carbon projects, what we have seen is also quite an evolution in the governance of these projects. I mentioned that the projects have begun quite early in 2005, but until 2023 is when we saw the first mention of carbon markets in Kenya's regulatory and legal environment. And that happened with the amendment of the Climate Change Act. We then had regulations to operationalize the Act in 2024, and these set out how carbon markets should be developed. They create a regime for approvals, they create offenses for lack of compliance, and also create a regime for benefit sharing of revenues. Then we have currently in progress, draft climate change carbon trading regulations, which seek to have a domestic carbon trading environment in the country, and which will see the Capital Markets Authority play an active role in ensuring domestic trading. And then we have, at quite an advanced stage, carbon registry draft regulations, which seek to operationalize a national carbon registry system. From a tax perspective, this carbon markets regime doesn't have very clear-cut indications on how these projects are being conceptualized or treated for tax purposes. And so we then fall back on the tax laws in the country. And I then hand over to my colleague, Alex, who then will share what we are seeing in the tax regime and what the recent case of Wildlife Works means for us. Over to you, Alex.
Yep, thank you, Clarice. I guess everyone can hear me. Clarice, maybe you could just confirm.
Yes, we can hear you. You could just put the slides back on slide share and then proceed.
Okay, great. So picking up from where Clarice has just left.
Sorry, Alex, just put your camera on, please.
All right, just a moment for that. Moment, I need to stop sharing and then put it on and then go back to sharing. Great. I guess now you can hear me and you can also see me. Thanks. So just picking up from where Clarice has left in terms of the legal and regulatory framework in terms of carbon markets. So this pieces of law is what is governing the carbon market space in Kenya, together with what is being developed, and Clarice has mentioned is at an advanced stage. Now, when you look at how then we are dealing with carbon projects from a tax perspective, and which is the reason we are here, and because of also that recent case, the wildlife case, then it calls for us to then think of what really happened in that particular case. But even before we go to that particular case, what is the legislation around taxation of carbon projects? So when you look at it from an income tax perspective, especially if you're looking at generating of carbon revenues for profit, and we'll see this in the case, is that the rate that is applicable is a 30% corporate tax rate. And there's an incentive for companies that are operating a carbon market exchange, provided you're certified by Nairobi International Financial Center Authority. If you're operating such an exchange, then your corporation tax rate reduces from 30% to 15%. In terms of value-added tax, when we look at our Value-Added Tax Act, it doesn't specifically place carbon as either goods or services, and perhaps that's something that our legislators need to look at. But when also looking at it critically, you also notice that the way our VAT regime works is, if something is not zero rated for VAT purposes or exempt for VAT purposes, then the default rate of 16% VAT applies. So I guess that's something that also we need to look into. But if then you are dealing with exporting carbon credits, whether you call it a good or service, at least it's clear within our VAT regime that export of goods or services is zero rated for tax purposes. Yeah. So But what we're learning, and from our experience in dealing with tax on carbon projects, there is really a gap in terms of then how to look at taxing carbon credit revenues. And this gap becomes even more clear when you look at how transactions in the carbon market space are structured. You will find multiple entities doing different things in that particular space. You'll have an entity that is perhaps is a project developer. The developer is in touch with the farmers or the guys who are managing the forest to be able to get those carbon credits, but you then have another entity that perhaps is more focused on marketing these particular credits, and you have the local people who also want to get a share of these. You have the credits, for example, being sold offshore, or you have local entities or even individuals or people assigning these credits to foreign entities. So you have a complex web around how, for example, carbon credit revenues are being sold or marketed, or even the revenue, how it is being generated. And we then come to this particular case of the Wildlife Works Sanctuary Ltd case, which is a recent decision by the Tax Appeals Tribunal. And I want to put a rider that indeed the case is subject to appeal. Either party, either the Kenya Revenue Authority or Wildlife Works Sanctuary, can appeal to the High Court. But this particular case gives us some reasoning or some ideas of how the Tax Appeals Tribunal, the Kenya Revenue Authority, will then approach taxation of carbon revenue. So in terms of background in this particular case, we had Wildlife Works Sanctuary Ltd, who had taken the case to the Tax Appeals Tribunal. The Revenue Authority had raised an assessment of 6.89 billion Kenya shillings. So you can imagine even just the size of this particular assessment, and perhaps even it explains the focus why we are seeing a lot of KRA officers focusing on carbon projects, because they see this as an area perhaps they could collect much more in terms of revenue. And in this particular case, the issue was that the Revenue Authority, basically was saying there's carbon revenue that has been generated from the country, and they were looking at different relationships between entities related to Wildlife Works carbon, which we'll look at, and looking at it also from a transfer pricing perspective, and saying that they believe that the local entity was actually earning much more income and should have accounted for corporation tax and withholding tax. But where that particular income ought to be placed is something that also was discussed at length in that particular case, and we will see that as we continue. So let's look at just how this particular project was structured, at least from the case that we have seen. So we had Wildlife Works Carbon LLC, and part of their work was funding the land that is being used to generate the carbon credits, sourcing, looking at whether the project is feasible or not. The entity was also involved in selling of carbon credits, and had entered into several agreements with the landowners for purposes of those credits. On the other hand, you then had Wildlife Works Sanctuary Ltd, WWS Kenya, and this is the Kenyan entity that was in the Tax Appeals Tribunal, and the work of this particular entity was basically supports Wildlife Works Carbon Ltd. You have your usual admin, your usual HR, finance, or just administrative support for the project here in Kenya. And for that, Wildlife Works Sanctuary Ltd was being compensated at a markup of 7.5% on the project cost. So, and again, Wildlife Works had done a transfer pricing policy to arrive at this particular way of doing things. Then you had another entity, Everland Marketing LLC, Everland, and Everland was basically involved in the marketing of the carbon credits that were being generated from the project. And then you had Wildlife Works Carbon Trust, WWC Trust for purposes of this presentation, which was receiving 50% of all the revenues from the carbon credits, or rather the profits from the sale of these carbon credits, and channeling these to the community, basically the guys who are in the project. Yeah, and perhaps we can speak a little bit about this towards the end, because there's also a requirement for certain revenues to be distributed to the local community. Then you have the local carbon committees. Basically, the landowners then form a committee, basically for easy administration, to receive funds once the carbon credits are sold, and then perhaps distribute these funds to the landowners. So basically, this is the end-to-end supply chain for that particular project as we understand it. So there were three main issues in the case which we want to look at. Number one issue was whether KRA was justified, and KRA is the Kenya Revenue Authority, was justified in attributing carbon revenues to the entity that is in Kenya and assessing corporation tax. Number two is whether the transfer pricing adjustment that was being done by the Kenya Revenue Authority was okay, was proper. And the last issue was whether withholding tax was correctly imposed on deemed dividends. And we'll discuss this one by one as we look at each issue on its own. So starting with the first one, in terms of whether KRA was justified in attributing the revenues to the local entity here in Kenya, what the tribunal observed was that there was a clear delineation of the activities of Wildlife Works Carbon LLC, which is the non-resident entity, and the role also of Wildlife Services, the entity that was in court. So there was a difference in terms, a clear role of what each party was playing in this particular project. And when they got deeper into looking at what the non-resident entity was doing in terms of the risks, in terms of the assets, in terms of the functions of this particular non-resident entity, they could see that funding, marketing, risks, revenue recognition, all these were resting with Wildlife Works Carbon Limited, which was the non-resident entity. Therefore, what that meant is that the revenues that were being made by Wildlife Works Carbon Limited, the non-resident entity, could not be taxed on the local entity, which is Wildlife Works, because according to the tribunal, the person who was getting this particular revenue, and rightly so, was Wildlife Works Carbon Limited, which was the non-resident entity. Yeah. So what we also see is that even though income that is derived or accrued from Kenya is subject to tax in Kenya, here the Kenya Revenue Authority had looked for perhaps the right tax, but on the wrong person, to just summarize it in terms of the first particular issue. And for this reason, then the assessment for corporation tax on the local entity failed. Moving on to the next issue around transfer pricing and transfer pricing adjustments. So there's a requirement within our local laws that if you are trading with a related entity, that trading has to be at arm's length. Basically, if I'm selling carbon to a third party sitting, say, in the USA, and I have a related entity still in the USA, a company that is related to ours, and I also sell to them the carbon credits, then the price at which I sell to an unrelated entity in the US should somehow be the same as the price that I'm selling my carbon credits to the US entity, which we are related. And for that reason, then you have requirements for having a transfer pricing policy where you clearly indicate what is the role of the related parties in a transaction. So in this case, Wildlife Carbon, the non-resident entity, and Wildlife Service needed to have a transfer pricing policy to say this is how we operate and this is how we ensure that our operation is at arm's length. So even if it's provision of services, that again has to be at arm's length. So in this particular case, you can see that the tribunal looked at the transactions between the WWS, local entity, and WWC, non-resident entity, and the tribunal was okay with the transfer pricing method that was adopted between these two entities. The tribunal was also satisfied as to the roles and functions of each particular entity. The tribunal was also satisfied that the transfer pricing policy was showing a markup range of between 2.64 and 10.78. So for WWS to apply a markup range of 7.5, that was actually okay. And for these reasons, then the tribunal held that the appellant's service fee was at arm's length, and therefore KRA's attempt to do a transfer pricing adjustment was wrong. Moving on to the last issue that the tribunal looked at is whether withholding tax was correctly imposed on deemed dividends. So, so when you look at this, KRA was looking at collecting first after doing the adjustments and trying to say that the local entity had made this much in terms of income. Then KRA went for two things. Number one, they went for income tax, the corporate tax, the usual corporate tax. And then number two, they also deemed a dividend to mean that because the local entity had, in their own quote unquote estimation, made profits, they ought to have distributed dividends, and these dividends would have also attracted additional tax. Currently, the rate for dividends to a non-resident is 15%, where there is no double tax agreement. So you could see the stretch that KRA was applying here, not only going for the income tax, but also deeming a dividend and also going for tax on the dividend. But the good thing is when issue number one collapsed, meaning that there was no income tax that was due from the local entity, issue number three, also on dividends, collapsed, and the tribunal found that it was not proper for KRA to try and collect withholding tax on deemed dividends on the local entity, which is WWS. So what are the key takeaways from this particular case? What are the lessons that perhaps we could carry going forward, especially for project developers or anyone who is participating in a carbon project? Number one, we saw that the local entity, which is WWS Kenya, was successful because it provided proper records in terms of how it was interacting with other entities in terms of the the carbon credits that they were dealing with. WWS was able to justify that this is what our non-resident related entity does, and this is what we do as the local entity. We have proper transfer pricing documentation. This is, the documentation for you. You can look at. They had proper financial statements, which they provided to the Kenya Revenue Authority, and this was helpful to WWS's case. And we emphasize on this because you could find that in a carbon project, that the documents and the relationship between the related parties is not clearly explained. You do not have even a transfer pricing policy. And of course, then it puts you at a weaker foot, assuming that you are that entity, and then you can see the approach by the Tax Appeals Tribunal and KRA. The other lesson, which is also very important, is that it appears from interpretation by the Tax Appeals Tribunal and the Kenya Revenue Authority that if you generate projects, you generate carbon credits in Kenya, and then those carbon credits are sold out of Kenya, the interpretation is you have then derived income or accrued income from Kenya, and therefore tax should be paid in Kenya. And I guess this is also important. And while the parties might still appeal to the High Court, it provides some level of clarity in terms of how the Kenya Revenue Authority is looking at carbon projects. So you could find a situation where, for example, the credits are generated in Kenya, but are assigned by the landowners to a non-resident entity. Then the non-resident entity sells those particular carbon credits outside of Kenya, and perhaps maybe also accounts for tax in the country where they are in. But now the Revenue Authority and the Tax Appeals Tribunal is kind of saying that if that revenue is generated from Kenya, regardless of where it is sold, or then tax applies here in Kenya. So that's a key lesson that we can also see from this particular case. The other lesson that we can see from this particular case is, and it's tied to point number one, is in terms of just the documentation that you provide to the Revenue Authority. We have seen attempts by the Revenue Authority to just estimate how much revenue a carbon project is making. They will come say, we have seen in your website, for example, that you have sold 1 million carbon credits. We have then gone to our website X, and as at 2025, they have told us that the price for one carbon credit is, say, $20 as an example. So we've taken your your website figures where you're saying that you sold 1 million and multiplied by 20, which is the price per credit. And in our view, or in their view as KRA, then say that we think you should be accounting for 20 million US dollars in terms of your income. Then they go look at your financials and say, when you look at your financials, we don't see $20 million disclosed as your income. We therefore have decided that we will raise our assessments based on our estimation of the number of credits you have generated multiplied by the value per credit that we have gotten from wherever. And this approach was criticized by the Tax Appeals Tribunal to say that assessments must be based on actual verifiable income and not just projections. Therefore, hypothetical data definitely cannot justify adjustments by the Revenue Authority. And basically reinforces why you need to have proper documentation, including your financials, tracking what exactly has been sold, at what point, has been sold at how much, and also tracking the expenses related to generating of those carbon credits, minusing that from your incomes, and then applying the correct tax at the end of the year. So that's important. And finally, of course, we would encourage everyone who is participating in carbon projects to be just ready for a revenue audit. Of course, we've seen trends where, for example, the Revenue Authority is successful in one case, and then they use that energy as a boost to then look at everyone else who is doing a carbon project and trying to assess tax on those particular projects. So it is important then for anyone who is involved in this particular space to look at their projects, how they are structured, what contracts they have entered into, how they are allocating the revenue to entities, and if they are related, whether there is a transfer pricing policy or not, to just have it ready so that if the Revenue Authority comes, then whatever approach you have is defensible. All right. We also have other lessons that we can learn on the global scheme of things, not just from this particular case. And when we're doing some research around what trends we're able to see around taxation of carbon revenue, we thought, why don't we look at how the OECD is trying to deal with this? But we did not find any specific provisions on the treatment of income derived from trading of carbon credits. We then went to look at the UN Tax Committee, and the focus for the committee seems to be on carbon taxes and environmental fiscal measures rather than taxation of carbon revenue. So when we talk about carbon taxes, environmental physical measures, here you're talking about instead of looking at the revenue generated from transfer of carbon credits, we are looking at perhaps the polluter pays principle and saying, why don't we come up with carbon taxes so that then we kind of levy this tax on the polluters so that they pay us something. So you can see that there's a difference here, because on one side there are people who are looking at, this is money, let's tax whatever is generated, what revenue is generated from carbon credits. On the other hand, you'll also have the view of, let's punish or perhaps discourage those who are emitting carbon dioxide and related gases into the environment by levying a certain particular amount as carbon tax. And this is the approach basically that you see with, for example, South Africa. So with this in mind, then this WWS case in Kenya helps to just provide some form of way forward, at least for project developers in Kenya, because it appears like we are looking at source-based taxation, looking at where the income has been generated from carbon credits, and also trying to tax this. Let me put a rider here, because when we look at our medium-term revenue strategy for the government, there is intention for the government to introduce carbon tax. So as it is right now, that still remains an intention. But when we look at the implementation matrix in that medium-term revenue strategy that stretches from 2025 to 2027, the government plans to introduce this in 2026. So we will be keeping an eye on that to see how government will approach it. Will it approach it the UN Tax Committee way of discouraging those who are polluting, or will it have more focus around appreciating whatever revenue is generated and trying to tax that? So that's something to look out for. We then went to look at India and see how they're also approaching this in terms of just taxation. And we had this case of Mayu Dichem Intermediaries LLP versus the Revenue Authority there. And here the case was revolving carbon revenue that was generated by Mayu Dichem intermediaries up to the year 2018 period. So, and in this particular case, the company was engaged in printing of paper, and even as they were doing printing of paper, they decided they want to, adopt, use renewable sources to run their factory, and basically decided to use biofuel to be able to manufacture the printing paper. So up to 2018, the laws in India provided that if, for example, your business is printing paper or whatever, manufacturing, and you have credits that you have generated because of using renewable sources, then those credits which you received, and perhaps you could even sell them, could be treated as capital assets as opposed to revenue receipts. And what's the distinction, you may ask? The distinction would be that if, India was trying to use this as a way of it's incentivizing anyone who's into manufacturing to use, clean energy. And in this particular case, you could you manufacture, you've used clean energy to manufacture, they appreciate you, give you a certificate and tell you, well done, and you could use this particular certificate for the amount of credits that have been given, and you could actually sell and generate some money out of it. So when the court was looking at it, they were saying when they look at the legislation as it were then, the purpose was to incentivize, was to encourage anyone who is involved in manufacturing to then generate the carbon credits and and sell them, and not, the intention was not that then once the money is received, then you are subjected to further tax. Yeah. But this was up to 2018, because then India changed its laws through an amendment to one of the sections, section 115 BBG of the Income Tax Act. And then what they did is to say that there's a rate, they introduced a rate of 10% to apply on all carbon revenue from 2018 going forward, and that is the applicable rate as we speak now. However, we also notice that this is lower than their normal corporate tax rates, which is ranging between 15 and 35%. And the reason for the range is because there are many incentives, and it all depends on whether you're a domestic company or you're a foreign company. But even then, you can see the 10% is lower than the lowest corporation tax rate. Basically to say, fine, we want to collect some revenue out of this, but we will not tax you the same way we would tax you for your normal corporate business. Your normal corporate tax is not what will apply. And this is a lesson not only for taxpayers, but also a lesson for the Revenue Authority, because at the end of the day, I believe as a country, we still want to encourage the generation of carbon credits. And for that reason, then we should have a different approach, because when we have these carbon credits, of course, it helps us to achieve our targets in terms of our emissions and reducing emissions, which is a plus for the country. It encourages using of sources that are perhaps friendly to the environment, which is good, and it's aligned to the government policy. Therefore, then the approach to then just tax at 30% is therefore doesn't really incentivize one to participate in such projects. So with that, I come to the end of our presentation, and it's a good time to then allow you to ask questions. I don't know whether there are some that have come through the Q&A, and then we'll take it from there. Thank you very much. Shane, let us know if we have any questions, and Clarice, if there's anything you may want to add, please feel free to add.
Thank you, Alex. That was really good, great overview. I have nothing further to add, but we are open for questions. The remaining time we have, we look forward to an open discussion. I see one question in the chat. I think Sain will take us through that.
So yes, there's a question from Hati Adhiambo, who says, for carbon revenue attributable to the non-residents, would they need to appoint tax representatives to file CIT or VAT? Alex, you're on mute.
I'm saying we can continue. We get maybe like 3 or 4. Any other question?
Yes. There is another question from Maggie Hobbs. How was the income to the community groups handled?
How was the income to the community group?
Yes, handled.
Okay. And
then there's another question from Matt King, who says, thank you for this excellent presentation, but I'm still confused. Takeaway number 1 says that credits transferred from a Kenya co to a non-resident company via a robust and well-documented transfer policy will not have those credits taxed as CIT. But then lesson number 1 is that carbon revenue yielded from credits generated in Kenya is taxable per CIT. Which is it?
Okay, I understand the question. Another one?
is similar, same from Matt King. Did the tribunal in its ruling define what it means by core project functions of a carbon project, which would be crucial in determining which entity holds the risks, funding, marketing, etc. within the corporate structure? If so, why are they? Yeah.
Okay. Maybe you could start with those four as you get the other four coming.
Okay.
So yes, the first question was around whether KRA will perhaps proceed to appoint tax representatives for non-resident entities to file for VAT and income tax. As it is, this is a new development. Remember, in this particular case, the Revenue Authority went for the local entity and it failed. So we are not too sure whether if they were to go to a non-resident entity, they could then appoint them to file this VAT and income taxes. But we have provisions within our Tax Procedures Act, which then allow the Kenya Revenue Authority or allow even a taxpayer to appoint a tax representative in Kenya to be able to file for this VAT and income tax. And I think we have to read this together with a very new development in through Finance Act 2025, where the Tax Procedures Act was also being amended to allow KRA to issue, for example, agency notices to non-resident entities for purposes of collecting tax. The other question was around how was the income to the community group handled. This was not subject to the case, so we are not able to answer that as at now. And then to Matt, who asked then, that confusion or interplay between proper documentation vis-a-vis all the amount being taxed in Kenya. Well, I think here the clarity will be there's reason or need that this proper documentation then says this is the income that has been accrued from Kenya, and these are the entities that are involved, and these are the expenses, so that at the end of the day, then you have your income less expenses, especially for the local entity. And if then they go for the non-resident entity, your first line of defense will be that documentation or transfer pricing policy. Of course, what we are seeing with this particular case is that KRA will try to stretch it and say that, of course, all income that has been derived or accrued from Kenya is taxable in Kenya. But even if they were to say so, of course, the normal principles of showing what the income is vis-a-vis the expenses and how that income is correctly disclosed in Kenya and based on the functions of the local entity and also taxed in Kenya becomes very, very important. Was there a definition of what would be the core project functions with this particular case? There was no definition, but what is important is, as it should be, that you clearly delineate what the non-resident entity does, and you make sense of how it is compensated for what it is doing outside of Kenya. The aim here is to ensure that there's no profit shifting from Kenya to the non-resident entity, so that then Kenya collects less taxes. So a transfer pricing documentation then becomes very important, because every project will have its own definition of its core project functions. Thank you.
There's another question that says,
yes.
What was the conclusion on whether the carbon credits are goods or services?
No, the tribe. Okay, I think let me answer that, because I anticipated that question would come. The tribunal wasn't looking at the classification of the carbon credits as either goods or services. It was just looking at the income that has been generated from the carbon credits.
Okay. Alfred is asking, does this somewhat mean a loss to the goals of and roadmap to carbon trade?
Okay, let's get another 3.
George Mbatai says, good presentation. Can you send us the tribunal case judgment or ruling?
But I'll send you. But is a friend. And so
Okay.
is Matt King. I know Matt as well.
Okay. No other questions.
All right. I guess the only question that we have is whether this could potentially be a loss for carbon trade or how the market develops. I don't know whether Clarice, you want to go for it?
Yeah, I think I can try. Then we see what your thoughts are as well. For me, I don't think it's a loss because the market craves clarity. So the decision for me is one that sheds a bit more clarity. There've been a lot of questions, a lot of audits behind the scenes, but no one knows how they were concluded. So now we have something in the public domain and some information that gives clarity to participants in the market about how to proceed. It's also not a loss because at the end of the day, the government has actually said that they believe carbon credits will be Kenya's greatest export, and that's what they are pushing for. And there's signs that they are hoping to raise revenue. The question that arises is how much revenue, how reasonable are the expectations of how much revenue will be collected? And it opens up a way for us to see, is there a way to lobby for a different or special rate of tax? I think Alex shared the India example, where there seems to be a methodology for incentivizing carbon projects while still helping the government earn some revenue. So in Kenya, we currently only have the incentive for exchanges where the tax rate is 15% if you set up an exchange. It means there is possibility to further incentivize even the income tax regime for these projects. And this, I think, case opens up that that discussion. Yeah, I think, Alex, I don't know what you think about whether you agree or you're contrary to my opinion.
Yeah, I think I appreciate the clarity and guess when we are looking at carbon revenue, we should not be just looking at it from the revenue perspective. We should be very careful so that you still incentivize anyone who is generating the carbon credits to make sure that they continue with that. And if you want to collect tax, then you collect something out of it, but it's not meant to punish you so that you feel like it's the cost of just generating those carbon credits doesn't make sense. So a balanced approach is therefore the desired.
One last question from Emma Koskei, who says, is there a tax applicable to the markup in such projects? For example, on the 7.5% for WWC? Yes.
So with transfer pricing, assuming you have taken the cost plus method, which was applicable in this particular case, what normally happens is you have all your project costs, you lump your staff costs, any admin costs, your office costs, perhaps all these come to 1,000, and then you have done your transfer pricing policy and you're right at a markups of 7.5%. So the tax then will be applicable on this particular markup of 7.5%. So if you take 7.5% of this 1,000, perhaps you're talking about, what is it, 75 is what will be subject to corporate tax in Kenya. Yes. So in short, tax applies on the markup.
Maybe we have time for one last question from Matt King. He says, perhaps this is for Clarice. Given the ITMO fee for A6 authorizations, which is essentially a tax on that A6 derived carbon revenue, do you think application of CIT, even at a lower rate, would be appropriate for A6 ITMOs?
That's a loaded question, Matt. Thanks for that. I mean, I think as it stands, this case is showing us that corporate tax is applicable and it's at 30%. And then the carbon markets regulations, the second schedule has the 4 USD for ITMOs. I agree with you. It then becomes quite heavy when looked at in that way. And maybe then we can question what are the allowable expenses that you could deduct, Alex, to help you reduce your income tax, your corporate income tax in that way. But I see your point, Matt. And I think collating all this different information and different experiences and putting up a case to lobby would be important for either an exemption or less tax, but it would definitely be a heavy burden. Alex, on expenses that are allowable, maybe that would help because as it stands, the at 4 USD dollars is there, it's the law, and the corporate tax at 30% is still also the law. So how do we mitigate before the law changes? How do we mitigate the tax burden?
Yeah, I guess for expenses, allowable expenses, those ones are already provided for under our Income Tax Act. I believe Section 15 of our Income Tax Act basically lists all expenses that would be allowable. And the basic principle is any expenses that are incurred for purposes of furthering one's business are allowable expenses subject to what is provided in our Section 15 of the income tax as read with Section 16, because Section 16 then provides a list of expenses that are not allowable. So maybe there's no special, if I could call it, expense that has been put there to be claimed by anyone who is then generating carbon credits. And yes, it can be painful looking at all these taxes that have to be paid. And maybe you could have told us, Clarice, what is ITMO?
Okay. So ITMO means internationally transferred mitigation outcomes. And so under the old dispensation, we were dealing with the CDM, Clean Development Mechanism, the Kyoto Protocol. But of late, if you're in the space, you'll hear a lot of talk of Article 6. And the ITMO is now one of the assets. We're not talking about CERs anymore. It's the ITMO, which is now created under the Paris Agreement, Article 6. And it's basically an asset similar to a carbon credit, only that it's being generated under Article 6.2, and a country-to-country trade is possible for that particular asset. What Matt is mentioning is that in Kenya, if you're trading an ITMO, that is the ITMO, if you're trading it, there is a 4 USD fee for each ITMO. So if you're trading a number of them, it's 4 times the number of ITMOs that you'd be trading. And this fee is paid to the government of Kenya. The rationale for the 4 USD was that when you transfer an ITMO from Kenya to another country, that ITMO cannot be claimed by Kenya, and Kenya cannot claim the reductions of that from that particular project. So Kenya imposed that particular fee to cater for the opportunity cost of giving up the right to claim those emission reductions as being owned by Kenya. That was the rationale for the fee. But of course, it then makes you've generated ITMOs and then you sell them, and then you have to give up 4 USD to the government. Creates a fee that's onerous, and there have been questions about that. And yeah, so in a nutshell, that's what it is.
All right. I guess we are through with the questions, and also our time looks like it's up. We want to encourage you to give us feedback on your screens. You're able to see the QR code. Please scan it and give us your feedback. The other thing that we wanted to mention is we've just released our tax outlook for 2026. So look for it in our website if you haven't received an email with that particular tax outlook for 2026, and feel free to engage with us. And finally, to just say that it doesn't mean, with the ITMOs plus whatever you're talking about, taxation of carbon projects, plus the many fees that we have within the regulations, there's also, of course, the feel that there's need to look at this carefully to ensure that we still incentivize guys who are involved in carbon projects. So, and we are at a good stage because the National Treasury and Parliament and Kenya Revenue Authority are open to receive comments on how to tax carbon revenue, and feel free to either through us or directly provide those comments to the relevant authorities for consideration. So I guess with that we come to the end of today's webinar. Thanks to everyone who participated. Clarice, we really appreciate you. Thank you so much for the insights. We thank the team that has been involved in putting this presentation together with the support that we are getting from our in-house team. We appreciate all that. So I guess that's it, Sane, unless there's anything I may have missed.
No, that's fine.
Great. Thank you very much. Give us your feedback in the QR code. Clarice, any remarks to close?
No further remarks, just to echo your thank you to all participants and to the team that has supported us putting this together. This is just the beginning. We plan on keeping you informed throughout the year. So stay tuned and have a lovely day.
All right. Thank you very much and goodbye.